Hello and welcome to the Chamber Music Mindset. My name is Anna Rathbun and I am your host. We're going to start talking about the markets and what happened last week, especially with the Fed rate cut. But before we start, I need to remind you that none of what you hear today is investment advice and everything is for informational purposes only. Hopefully this helps you to understand the markets and what is happening around us a little bit more. And if you have questions, you can actually ask questions at Connect, CONNECT, at granadilla-advisory.com. That's connect at granadilla-advisory.com. Okay, let's get started. We had a fantastic week last week. It was not uneventful, but we did end the week with equity markets going up. In fact, on Thursday, the S&P 500, which is large cap stocks in the United States, Russell 2000 index, which are the small cap stocks in the United States, so smaller companies, and then NASDAQ, which is basically tech stocks. Just think of it as tech stocks. They all reached record highs on Thursday. This is an incredible environment. It's almost as if the markets have forgotten that there are tariffs and geopolitical tensions, etc. The markets are just, as I mentioned last week, melting upwards. Now, this wasn't just melting upwards without any reason, right? We did have a significant event last week, which was the Federal Reserve coming out with the September policy. The Federal Reserve cut rates by 25 basis points. I'm going to talk about Fed policy and yield curve and how that impacts the rates that you and I experience later in this video. But let's suffice to say for now, that cut was fully expected by everybody. In fact, in last week's video, I talked about it. It wasn't just me, it was also the markets. We were pricing it in. And therefore, was it a surprise? No, right? So what happened on Wednesday, actually, the markets, as I said last week, just kind of moved along almost in a horizontal fashion. At 2 o'clock, there was a knee-jerk reaction in the rest of the afternoon. We were digesting, the markets were digesting what the cut actually means and all of the thought process that went into it that Federal Reserve Chair Powell actually described. And frankly, despite the fact that the Fed cut rates and this is, normally a good news for the markets actually fell that day. And the simplest explanation is that because the markets were pricing it in, why go up, right? So there's a little bit of taking of the gains that's happening, but there was some other stuff. So let me share with you some of the things that the chairman said. The Fed, actually, before I go to Chairman Powell, let me just talk about what the Fed actually communicated in their very, mysterious way. They have something called the Summary of Economic Projections, where they, come up with independently, they're all doing this independently. They give their own version of what they think the inflation will do, the CPI will do, what they think the growth trajectory is going to look like, and where they think policy rates should be. So there is something called a dot plot. You might have heard of it inside of that Summary of Economic Projections. And the dot plot gives you where the Fed officials actually voted on, where they think rates should be. And that makes a suggestion. So the suggestion that we infer from the dot plot and the Fed communication was that not only was there a 25 basis point cut, the dot plot signaled 2 more cuts in 2025. Okay, so that would be a cut in October and another cut in November. So basically every policy meeting that the Fed has, they're anticipating to cut by 25 basis points. Now, again, I hearken back to, I think it was Michelle Bowman who said we should probably have 3 cuts. And I keep saying, oh my goodness, she was right. She may have been right. And maybe this is going the way she thought it should. Now, so the market's reacting some in a mixed way. What else was there, right? Fed Chairman Powell actually cited labor market concerns. He did say that there were concerns. And he said, you can think of today's move as a risk management cut. And that risk really is about the labor market. Again, this is not good news. So the markets probably were a bit hesitant. That would be the simplest explanation. He also said we should be moving toward neutral because of labor market risks. Hooray! If you have been watching this, you know that I've been saying this for a while. If you've been following me even before I started this company, I've been saying this for a while. Why stay so restrictive? We should be moving toward neutral. Just normalize the rates, right? So thank you, Chairman Powell, for saying that. So we are moving toward neutral by way of 25 basis point cuts. He also said that tariffs still have a danger of persistent lift in inflation, persistent upward pressure on inflation. So he's not giving up on inflationary risks, right? He's saying that there is still a risk. He believes, or the Fed believes, that the impact, they are expecting it to be one-time price hikes. And so far, it has been slower and smaller, the tariffs being priced into what we are experiencing as cost. But we still have to see. That is the message, okay? So for the rest of the video, I want to talk about the yield curve, because what happened in the yield curve, and I will define this for you, was fascinating. It was fascinating, but it's sort of like, it's fascinating in a sense that we're talking about it, but the yield curve moves independently of policy all the time. Okay, so let me close up the market update here. Basically, we had a great week for the equity markets, for stock markets, and that's the takeaway. It's getting more and more expensive because we keep hitting record highs. And when that happens, basically, it becomes more vulnerable to outside shocks. So if we have negative news somewhere, if it's super expensive and highly valued, people get scared and they tend to sell. So record highs, it's been a really great market. But what goes up must come down. Nothing goes up in a straight line forever. So the risks in some ways have increased. So this is something that we deal with as investors all the time, the risk and reward of being in the equity markets. So, okay, the next segment will show you, or I will try to explain to you this whole thing about the yield curve and what's driving it and what that means for your mortgage rates as well as your money market rates. Okay, let's do a primer on interest rates, yield curve, and what it means for, two things. Mortgage rates and your money market rates. I think a lot of people out there, including you, may have assets in money market. It's going to change in terms of what you're earning. Before I start, people have asked me about this guy. His name is Lucas. He is my Australian Shepherd boy. He's a blue merle. He's going to turn 3 years old in October 8th. I'm contemplating what to do for him for his birthday. Not shown is his little sister, Stella, another Australian Shepherd, a black tri, because she is my third dog child. I think the same thing happens with real kids, real children. I haven't been good about, taking photos of her and actually framing it, which is why you're not seeing it. But that is one of the things that I really need to do. Okay, let's talk about yield curve. But before I really go into it, I need to get through some basics. So this particular segment is about the basics of the yield curve. If you need a refresher, you already know, but you want a refresher, please stay tuned. Otherwise, you can probably fast forward if this is boring to you. For a lot of you, I know that this is going to be a new concept because I know my viewers want to learn more about this stuff. Okay, what happened last week? The Fed lowered rates, but the 10-year yield went up. What do I mean by 10-year yield? It's like, think of it as the United States is borrowing money for 10 years and they're paying interest on it to you because you're buying that bond. You have to be compensated every year for 10 years. Okay. The question is, What are you going to be compensated on? What is the coupon rate? What is the income rate? That is what I mean by the 10-year yield. What are you yielding out of that bond? Okay. So the Federal Reserve lowered interest rates, but the yield went up. What you're getting compensated for, what you're yielding went up. So the costs of borrowing for the United States went up for anybody really for 10 years. Shouldn't that have fallen? Shouldn't everything have fallen? So this is where we're going to go into what we call the curve, yield curve. But there's a lot to cover. Before we go on to that, we're going to talk about what happens in terms of price and interest rates. So in the stock market, everyone sees this. When people are piling on, I want, I'm buying stocks, price goes up. It's like that in anything in real life, right? If there's a high demand for something, then price goes up. And same thing happens in the bond market. If I really want a bond and everybody else wants to buy bonds, price goes up, like anything in real life. But the yield or the rate or the borrowing cost goes down. Okay, because hey, maybe all these people want want to lend to me. Well, maybe I don't have to pay them that much, right? That's the psychology of it. There's a mathematical bond calculation aspect of it, but we won't go into that now. So there is this inverse relationship between price and interest rates, or the rate going down, or the yield, borrowing costs, all of that, interest rate for the 10-year or 20-year, 30-year. That's what you have to remember. So when I see 10-year yield going down, I know that people are piling on for various reasons. It's either because people are saying, oh my goodness, things are too risky. I need a safe haven asset. I need to own something safer. So I'm going to pile on into US Treasuries, which are safe. And so the 10-year goes down. If I see the 10-year yield going up, I know they're selling, right? Don't always know the reason why, but there is selling. Okay. So that's the basics of price and yield movement, the inverse relationship. So when I say a yield curve, what do I mean? You have to think about it as the shortest term for lending, which is overnight lending. It's not even one full day. It's like overnight lending, and that's called the Fed funds rate, and that's what the Fed controls. Okay, you go out, you can borrow for a week, you can borrow for 12 weeks, which is 3 months. You can borrow it for 6 months, a year, 2 year, 5 year, 7 year, 10 year, 20 year, 30 year. And that is the term of timeline of the US Treasury market that we benchmark. Okay, and then that's on the x-axis, so it's timeline. And on the y-axis is the yield, the interest rate. Okay. And then what we do is we dot it like, right. So what is the rate at something is selling at for the 10-year, the 7-year, 5-year, going all the way back to overnight or out. And that is when you connect those dots, it's the curve. That's the yield curve. Now, when the Fed moves on its policy, so they cut rates last week by 25 basis points, all they're controlling is the the shortest end, the overnight lending rate. We call that the Fed funds rate. That is frankly all that the policy is moving. And it's not even deciding it. It gives you a range. And then the actual Fed funds rate actually floats in between. So they're not even actually targeting a certain rate. This is what people don't always talk about. So the Fed isn't really controlling everything to the fullest. They're just telling you what where they want to hold the Fed funds, the overnight lending rate. And from there on, across the timeline, people trade, right? So earlier I said when you pile on and there's a high demand for bonds, the rate goes down, right? The yield goes down, right? Implicit in that is that there is a market activity, right? Some people are wanting to buy. It's a marketplace of people wanting to buy and sell. And sometimes, the buying overwhelms or the selling overwhelms. Okay. And then it moves the yield. Everything outside of the Fed funds rate, which is the overnight lending rate, is determined by the market. That's how you get what we saw last week, where the Fed cuts rates, but the 10-year goes up. How much did it go up? We ended Tuesday at 4.026%. 4.026%. That was the 10-year yield. On Wednesday, after the Fed cut rates, we went up to 4.076. And then it kept going up. We ended the week last week at 4.139%. So traders were selling. People were selling. Even though the Fed cut rates, the longer end of the curve went up. So the question is, why are they selling? Well, we would have to ask every person, right? Which is impossible. Here are some simple explanations. Fed cutting rates, great for riskier assets like stocks, because stocks ended up going up for the rest of the week, right? Well, you got to sell the safe stuff to buy the more expensive, more risky stuff. So you could kind of surmise that there was selling pressure on Treasury market to buy, equities. Okay, that's one explanation. The other is that the Fed said, there's a likelihood that there may be an upward pressure on inflation. Well, if there's going to be upward pressure on inflation, and the Fed is uncertain about the fate of inflation yet, then I got to get compensated for that inflation on the longer end. The longer end is sort of made up of, again, simplifying, growth rate, long-term growth expectations, and inflation expectations. Those are the two big drivers of longer-term interest rates. Well, if interest rates are going to be higher and there's a potential for that, I need to get compensated more, which means I'm selling today. And that's why the rates are going up. I know that was a lot. Again, if you have questions, you can reach out. But the takeaway here is that the Fed only controls the overnight lending rate, and the rest of it is determined by the markets. That is a really important takeaway, that the Fed isn't controlling every part of that curve. The Fed isn't controlling the 10-year yield. The Fed isn't controlling the 30-year terms of your mortgage. That is not what's happening. There are a lot of forces that are going up and down outside of what the Fed is saying about the overnight lending rate. Okay, I hope you didn't actually skip that last segment because I ended up explaining a lot more. Okay, so before I get to what we want to cover for next week, which is basically what will happen this week, some of the things that are coming up, I do want to talk about, what moves the longer end of the curve and what could have potentially moved it last week. I did talk about some of the selling because I want to be able to buy risky assets like stocks in the previous segment. I also talked about maybe selling the longer end of the curve because inflation expectations are higher potentially. If Chairman Powell comes out and says, we were still uncertain, but tariffs could potentially have a more sustained upward pressure on inflation, then those are the types of comments that can move the markets, especially in the Treasury market, that is trying to price in what might happen 10 years from now. I mean, who knows, right? So again, growth expectations, inflation expectations. Those are the two things that, in general, move that longer end of interest rates. So if I think the economics of the U.S. is so great that the growth is going to be really much better than now, then I'm going to expect to get paid at least for the economic growth. And so my yield is going to go up. Okay. I want to get compensated for all the growth that's going to happen in the United States because I'm lending to the United States, right? So if I have a higher expectation of growth, that's going to go up. Inflation, same thing. If a higher expectation of inflation than today, then I'm going to be like, I'm holding this bond for 10 years. If inflation is going to be higher, every year I'm going to lose purchasing power. So I got to get compensated for that, right? So if inflation moves higher, the cost of borrowing for the United States and what United States has to compensate me for holding that bond, borrowing and lending to them, I have to have a higher compensation, which is what drives yields on the longer end up. The other thing is, central banks. Central banks around the world are huge buyers and sellers, or they're the traders of U.S. Treasury. Why? Well, number one, I mean, this is the largest economy. The Treasury market is a very, very deep market. What do I mean by that? It's huge. And there's a lot of activity going on underneath. And it's also got a great futures market because it's a deep market. So central banks tend to hold it. It's a safe asset. The other big reason is because the US dollar is a reserve currency. All the business is done in US dollars. Oil is bought in US dollars, at least still. So everyone needs to sort of have US dollars on hand. And the way you store that is by owning US treasuries, US bonds. This is why, like, when people say China owns us because they own so much of US treasury, it's not because China wants to hold the US hostage, because China needs to hold US dollars and US assets because it needs to be able to convert it into US dollars to do business. Okay. So central banks are huge holders of US Treasury. That's been going down a bit, but in the recent years, but that's a topic for another time. Huge pension plans also hold lots of bonds. They hold U.S. treasuries. They hold, global sovereign bonds. They use corporate investment grade corporate bonds. They're holders of bonds, these huge pension funds across the United States. So there's a lot of demand for bonds, sort of built into the structure. Insurance companies, huge participants in the bond market and huge holders of bonds. There are regulations, state level regulations on how much risks they can take. So they're huge bond market participants. Again, built in market for US bonds. I just talked about inflation and growth views. I did sort of touch on relative value. If lower rates, it's great for stocks, then why am I holding this asset? Relatively speaking, stocks seem to be more attractive. I'm going to go there, sell the bonds, rates go up, and then I'm going to go into the stock market. The relative value views of traders can sometimes have an impact on how rates move up and down. And I also talked about flight to safety. Oh no, things are looking risky. Too much risk for me. I'm going to own a safe asset, which is a US Treasury. So I'm going to pile on. If enough people do that, it pushes the yield down because the price is going up. Okay. That was it for the yield curve. So I guess I explained most of it actually in the first segment. It wasn't just the basics of the yield curve, but I did cover a lot of the basics. So if you want a review or if you want a refresher or you're just curious about what I said, go back to the previous segment and hopefully that'll satisfy your curiosity. Before we move on to what's coming up this coming week, I said I would talk about mortgage rates and money market rates. Now that I've set the basics, money market is on the shorter end. So it is a lot more influenced by what the Fed does. So after the Fed cuts rates or cut rates last week and maybe cuts rates 2 more times this year, you're going to see what you're earning in your money market account go down. Okay. So remember a few years ago when the Fed raised rates really, really high and people were getting like 5% in their money market accounts. If you've been paying attention, that has come down. People are earning anywhere from like 3.5 to 4. 4 if you're really lucky. It's really around in the mid 3s. The Fed cut rates last week. That's going to go down. And they're cutting rates again, in the future. That's going to continue to go down. So your shorter term, highly liquid, the things where you can just take money out very easily, easy to transact, all that stuff is much more influenced by Fed policy, more directly influenced. The longer you go out into the yield curve, like 5 years, 7 years, 10 years out, it's less influenced, as we just talked about. And that's where your mortgage rate sits. So mortgage rate benchmark yield, actually benchmark yield for a lot of things is 10 years. 10-year yield. That's why we talk about it all the time, because it's a benchmark yield. As I said earlier, the benchmark yield went up even though the Fed cut rates. Your mortgage rate is benchmarked off of the 10-year yield because your mortgage is a long-term loan, right? And if that goes up, mortgage rates are not going to easily come down. Okay, there's other stuff, impacting mortgage rates, including your own credit score and your own finances and your own, history and equity, how much you're putting down, etc. But at the very basis, the foundation of the mortgage rate calculation is that 10-year yield. So your mortgage rate is going to be a little more stubborn, while what you earn on that money market rate is going to go down. So this is not an ideal situation for most people. Okay, coming up this week, what do we have? I'm looking at my calendar here on LSEG, which is my this is where I get a lot of my data. We have the global manufacturing PMI. We're back to doing PMIs. You're going to hear me say this a lot because these things come every month. And there's usually a flash report and a final report. So they give you sort of a glimpse into what it might be. They do the final calculations and give you the final report. We always get some mortgage, report, and that's always nice to have. 30-year mortgage rate at the end, by the way, was 6.39%. It's still very, very high. Have a lot of housing stuff like building permits, etc. We have the GDP for the second quarter calculation, the final one. Remember, we started out saying, second quarter GDP grew at 3.0%. And then it was revised last month up to 3.3%. We'll see what the final calculation looks like. Like everything the government does, there are revisions that come. Well, it's a big country with 330 million people. You can't get it right the first time, and it is right to continue to revise the data. So good. We have some PCE numbers. Remember, this is the Fed's favorite gauge of inflation. PCE inflation numbers coming in. And, more. Well, yeah, there's a lot of home data next week. And then, of course, University of Michigan final report. Again, the last time we talked about University of Michigan sentiment going down was preliminary. We get the final one this week. So potentially a lot to talk about. If anything is sort of meh, nothing moves the needle, I probably won't bring it up. But if something does move the needle, I will bring it up. And any other topics that may come up. And you can be assured that in the markets, something always comes up. So I never run out of things to say. That's what makes my job so interesting. All right. Have a great week, and we'll see you next week.